One of the interesting things, I suppose, about Australian history in the last 30 years is that when we floated our currency, went from a fixed currency to a floating currency, the rate of exchange in the early 80s was, $1.30 US for every Australian dollar. We fell to less than 50 cents. In the early 2000s, we went back up again to $1.05 at the point that I was fortunate enough to go to Hawaii and had some fun with US dollars. So, the Australian currency's fluctuated quite a lot. Do you think that that's a sign of sort of, effective monetary policy, that Australia's been doing the right thing and just letting that wash through?
I think it has been helpful for Australia. That exchange rate flexibility has provided more insulation from the shocks from abroad. I also would add that Australia has had more open capital markets, like the United States, but more open than many other countries in the region. That's also been a positive. Those two things together have made the Australian economy work better. Of course, you can quibble, maybe the exchange rate fluctuation was too much, but it was going in the right direction. And I think it really hasn't been a focus on the exchange rates as a policy. It's really the exchange rates reacting in a helpful way to keep the economy moving more smoothly.
I think that's right. I mean, Australia's exchange rate in particular is very flexible to mineral prices because our terms of trade are very dependent on mineral prices. Right. And I suppose one of the things that Australia has really done is look at that open capital market structure, the more free market style of economics, and that's certainly assisted our central bank. But I suppose another thing that's assisted our central bank is that the economy's always been held back by the central bank, in the sense that, if they took the brake off, growth would accelerate, inflation would accelerate. A lot of countries around the world are now facing a different problem of sustained low growth, sustained low inflation, and finding difficulty in changing that situation. What should governments do to boost the economy and create some inflation now?
I think first on the growth, there's a lot of things that the governments can do. It's not all monetary policy, that's for sure. It's things that stimulate productivity growth, things that stimulate more labor force participation. Those have to do with taxes and regulation. And I think you can see some changes in the U.S. Is more emphasis on reducing tax rates, more emphasis on less regulation, and the hope is that will increase growth. And I think other countries could do that as too, including Australia. So the key in terms of growth is to do these things that would generate. We know from economics they'll generate more growth, but we've been reluctant to do that until recently. So I hope we do more of that, and not just in Australia and the U.S., but globally. In terms of inflation, I think the sooner we get back to a more normal policy, the better off we'll be in terms of inflation. It's actually kind of healthy that so many central banks have an inflation target, say 2%, 2 or 3%, whatever it happens to be. And so that creates some world policy which works best. But I would be very more positive if we got back to a more normal kind of policy like we had long before the Great Recession. And interest rates would be adjusting, and each country would know what the other countries are doing. I call it a rules-based policy. So each country has a rule, whatever it happens to be, and that's explained as much as possible to other people, including other central bankers. I think the world would work better in that mode, and in fact it did work pretty well in the 80s and 90s in that mode.
One thing we did see, if you look at the history of interest rates, for example, is that they were exceptionally high in the 70s and 80s and early 90s as a response to what was, significant double-digit inflation in a number of countries. Since that time and the introduction of a more rules-based system, interest rates have trended down. They fell fairly rapidly initially, but subsequently across the major economies, they've sort of tended to trend down over time. Do you think that that's a trend that will continue if we go back to a more normal rate? A more normal rate will be lower than it was a decade ago, or is that something over time you would expect interest rates to rise back up towards 7 or 8%?
No, I think a lot of the reduction in interest rates was the result of conquering inflation. We did terrible policy in the 70s, inflation began to rise, and finally in the 80s, many countries took different periods of time, but then attacked that inflation rate. Inflation came down, interest rates came down as a result of that, and the economy has worked much better since then. The debate now is whether maybe 1 percentage points in addition is due to other changes in the economy. Economists call this R star, or the equilibrium interest rate. Maybe that came down. Lots of people are doing research on that. It's not completely clear how much, but the magnitudes are much smaller than what you indicate. I certainly hope we don't have inflation coming back as we had in the past, and it led to lots of problems, misallocation of resources, ultimately higher unemployment. So I hope we don't go back to that. I think there's a real chance we could get a better world if countries were clear about their strategy, explained if they think the interest rate is lower and by how much. And the more of that dialogue that occurs, the more rules-based or strategy-based policy is, the better the world economy will work.
And just at the risk of perhaps sort of taking this level just back towards more basic principles, when you talk about a rules-based system, what are you talking about in terms of central banking?
Oh, it's pretty clear. Some central banks have followed a good rules-based system. I think in the US, much of the 80s was moving in that direction. 80s and the 90s were moving in that direction, the early 2000s. And then we got off of that. We had rates were much lower than you would explain based on the same kind of rule they used in the 80s and 90s. And you can see that in other countries too. So a rule is not necessarily something formal. It's just a description about how the central banks will raise interest rates when they need to, lower interest rates when they need to. And that has to do with inflation and the state of the economy. So it's explaining that. You can do it mathematically, but central banks don't need to be so specific. They just need to be clearer than they are now. There's some very good developments in this direction in the United States. The Fed is publishing in its reports rules that they think are useful, talking about how and when they deviate from them. So that's very promising.
And what sort of rules would the Fed be following at the moment, just in terms of for people who are watching this who aren't economists, who you know, don't understand what a rules-based system is, what would be an example of the sort of rules that...
Well, a rules-based system is, say inflation picks up. Then you say, well, we will raise our interest rates when inflation picks up. Or if there's a recession, we'll lower interest rates. And there's even some description about how much. For example, if inflation rate rises by 1 percentage point, it's probably a good idea to raise the interest rate by more. 1.5 is a frequent recommendation that comes out of rules. So that would be an example. Or if the economy goes into a slump, then you lower interest rates. So the rule, the strategy is, well, in these circumstances, we will change our policy. If those circumstances don't evolve, we'll keep our strategy or interest rates steady. So that's what a rule is. It's describing how the central bank operates in as clear as possible way. It's like sometimes a strategy is a better description of it rather than a rule. The rule might convey something more precise and mathematically that's possible.
One of the important elements of a rules-based system is the independence of a central bank, and I think we learnt that lesson the hard way. We had very politically influenced monetary policy for a long period of time, and it was fundamentally ineffective. We determined that the independence of a central bank was important. How important do you think independence of a central bank is in this modern world?
I think it's important. I don't think it's enough. I think you need to both have the independence and the description of a strategy. Those things go together. In fact, if you look at history, take the United States for example, same degree of independence in the law has led to different kinds of policies. We had an independent central bank in the 70s. The law didn't change, but the policy was terrible. Independent central bank in the 80s and 90s. The law didn't change, at least by much, and policy got much better. So you need both of those. I think it's very important to stress. Both of those are important.